advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner. My office is Asset Management Resources. We're a registered investment advisor firm. And our show is Something More. We call it Something More because we like to talk about not only those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Thanks for being with us for this episode, and joining me, I've got Jeff Perry. He's our regular co-host these days. Thanks, Jeff, for being here.
Thank you, Chris. Yep, always enjoy our conversations.
Lots to talk about today, and we have with us Brian Regan, our firm's Chief Investment Officer, who we haven't had on in a little while, so it's good to have you guys. It's been at least a month, Brian. Thanks for joining us.
Hi, guys. How's it going?
Going great.
I'm told, you guys strongly implied before we got on the air that I'm good at blowing hot air, I guess, or filling hot air.
No.
I think what I was implying, it's hard to get a word in edgewise. That's what I was implying. No, I'm kidding. You always have plenty of good things to share and opinions to have. You know, you don't mince words. You let it be known what you think. So we like that. So let's dive in. One of the things that we wanted to talk about this week was the fact that the Federal Reserve had a decision to raise rates another quarter point. Where does that leave us? 5.25, 5.5, something like that.
In that range, 5.25 to 5.5. I apologize if the listeners heard my sigh when you said that, by the way.
Well, why were you sighing?
Because I just wish they would wait and let all their rate hikes work through the economy and not just feel like they need to add a little more to the fire or ice to the fire. I don't know.
Yeah, right.
I don't know how to say it, but I
slow the economy.
The market was predicting that they would do this, so it wasn't a big surprise. The market didn't have a negative response to it or anything, but I'm going to go back to conversations we had a long time ago, and our listeners might remember we were commenting on things that Jeremy Siegel, professor at Wharton, had said, and he was encouraging the Fed to pause, which they did 1 month, but encouraged them to pause and let all these rate hikes kind of filter through the economy. They're not instantaneous, and I was hoping they would do that again this month, but they didn't.
Yeah, same. I thought it was a little bit of, I was expecting more of a talk tough to try to keep the market's expectations in a particular location, and they've still done that. So they may raise rates another time or two. Sounds like. Did I get that right, Brian? That there's still some expectation of future rate increases potentially, dependent on data dependent.
Yeah, in the meeting prior to the one this week, the dot plots implied that they thought they were going to have to raise 2 more times this year. So that implies 1 more. I'm with Jeff though. I think this one was unnecessary, and I think another one will also be unnecessary.
Yeah,
and that's mostly because there isn't any inflation anymore, and they should know that.
Well, maybe just share where are we when it comes to the inflation rate right now. It seems like it's come down considerably from its highs.
Yeah, the CPI rate it's at 3, and the core CPI is a little higher than that, but we know that that's coming down, significantly, between 1.5 and 2 points over the next couple of months. Yeah. Just as housing starts to filter into the data. So that should be at least a three handle, probably in the lower part of the 3s before the end of the year. And if you factor that into CPI as a whole, without any surprises from energy and food, which could very well happen, especially as we see, the grain deal fall apart,
right.
Just still alive there. We could be looking at a CPI that's under 2, with all that factored in, with all that core services stuff factored in, which isn't in the numbers now, just because it's a measurement issue. We've been talking about that for a year now, that these measurement issues in the CPI. And these measurement issues, they're just not a secret. I don't really understand. It's I don't understand why they're not seeing it. The market sees it. People understand it. It's getting filtered in. Stock market's reacting to it. Has been reacting to it since October, arguably June. So I don't fully understand what the Federal Reserve is doing here. I think they're trying to get some slack in the labor market. And it's pretty hard to do that without causing a recession.
Well, that's a transition perhaps to talk a little bit about, recession risk. We've talked about the idea that it seems like we've avoided a recession at this point. Things can change, but maybe that's something to talk about. What's our risk of the worry of a recession at this point, and what's your expectation?
Well, we're going to have one at some point. I mean,
that's true. Eventually.
Yeah. It's eventually. But one thing's for sure is the one that was predicted over the last 18 months hasn't come yet, and it's probably not going to come this next quarter either. So the question is when and how, and is it going to be 5 years from now, or is it going to be 12 months from now? We talk about soft landing, hard landing. The reality is the economy never really lands, right? There's always another quarter.
Yeah, right.
So
I read in the Wall Street Journal that the Fed comments, Powell's comments, even indicated they weren't expecting anything the remainder of the year in terms of to translate into recession.
Well, the Treasury Secretary said just as much a week or two ago, that she had changed her thoughts about a recession and didn't see it as imminent.
Yeah. Well, I think it's pretty clear. The consensus is that it's less of a risk now than it had been. Part of me thinks that's, why do they say that and they don't say that 6 months ago? I think it's just kind of time. I think people are just saying, where's it been? We're going to keep predicting this forever, kind of thing. Mm-hmm. I think the reality is, if you look at, what the causes of growth are in the economy, there's really three things. There is growth in labor, there's the growth in capital, and there's growth in productivity. So growth in labor, we've seen some people come into the workforce, which has been great. We've seen new jobs continually grow, which has been great. But the Federal Reserve tells us that they would like to see some weakening in the job market. So if you say that, hey, look, things are good now, but the goal is, let's say the goal is zero growth in the labor force, we're going to hit the peak amount of people working at some point. That we'll put that number at zero. Let's say that banks are tightening credit because we had a regional banking problem not too long ago. There's likely going to be some new regulations because of that. Likely, I would imagine people are going to be more careful about lending. Rates are 550 basis points higher than they were a year and 3 months ago. And if you have a floating rate loan, there's less likely chance that you're going to use your credit card or take out a HELOC. So that means that credit's going to flow less fluently throughout the economy. So let's say at the best case scenario, labor's at a zero, credit's at a negative. Well, we better see a lot more productivity, and that's certainly possible. What do companies do throughout 22? Well, I think a lot of them concentrated on cutting costs, whether it be labor or some other way. So if you think of productivity as just a growth in margins, producing the same widget at a lower cost per unit, it's possible you could see some productivity growth since it was so bad in 22. So I think we're really hoping, and then stack on artificial intelligence, which to me isn't really a new concept, but it's certainly more known to the general public now. And I think the economy is banking on an increase in productivity. I think we're going to be at best a low growth economy for a little while, and we've been slowing down from 7, 8, 9% in 21 to second quarter GDP is supposed to be about 1.5 to 2%. I think that's a reasonable growth rate, and we should be happy with that. But I think the reality is, with labor this tight, with credit contracting, you're a strong breeze away from tipping us into recession. And it's going to be some kind of exogenous event likely, or, some kind of blow up in a major sector that scares people.
Yeah.
So
I think a lot of people. Go ahead, Ryan.
I just want to cap it off. That's just saying, like, I'm not saying that recession is guaranteed, but I also don't think you should be complacent. I don't really think that's a change in my philosophy from over the last couple of years.
Yeah. When I'm thinking about the dangers to all of this, I think maybe it's because of my history, but I think of the challenging geopolitical events that could really throw, the economies off, trade off, looking at the issues in not only Ukraine, which is the obvious ones in Russia, but growing tensions and issues with China and Taiwan, and how a disruption in the relationship, whether it be trade or otherwise, with China could really change the whole picture.
Yeah, that's certainly possible.
Mm-hmm.
I'd like to come back. Let's go ahead if you want to comment about that further. I want to go in a different direction.
I just think exogenous shocks can come from, all sorts of places. If we could have some kind of, change to the pipelines again, for example, that could certainly cause an energy problem. I think energy problems are always something to be concerned with, and I think that's in line with Jeff's geopolitical reviews.
It is.
The only thing that I would, throw in there, and I think this every single time somebody brings up China, Taiwan, and it's not that it's not an issue, but it's been an issue for 75 years. This isn't new. I guess tensions are, higher, but I think this is probably more interesting on a political front than it is from a market's point of view.
That's probably something we could debate, but I'd rather not do that right now. I wanted to come back to a comment you were, pointing to the idea of, elevated interest rates creates more credit risk. And, we started this year with some, in March, I think it was, we had some, tensions with worries about banks failing. And that was in part because of the dramatic rise in interest rates that facilitated some of those challenges. Is that no longer a worry for the rising, continuing to raise interest rates at this point?
Well, if you think about what the main problem there was it was more about a flight of deposits, a quick flight of deposits caused by venture capital and cryptocurrency and investors that had bank accounts at those particular banks. And then that highlighted an issue where there was an asset liability mismatch where people were investing long on the treasury curve to try to make a bigger spread in a low interest rate environment, which turned on its head when interest rates went higher. The Federal Reserve essentially put a floor on that by lending money at par, so there was no longer a liquidity issue, and it made it possible for some of the smaller regional banks, most notably, First Republic, to merge into a bigger bank. I think there's still a lot of issues with regional banks, notably just profitability, right? So I think the idea was at the beginning of this rate hiking cycle that the banks were just going to make out like bandits because they were going to be able to borrow short, as they have been with great deposit growth, which they had been seeing, and lend at higher rates. And that worked for about 6 months. It seemed everybody was sitting pretty. And then all the deposit growth that they've had over the last 3 years, they saw disappear into higher earning assets, whether it be money market funds, treasury bills, banks competing over CD rates, and those spreads are going to contract. And that's just the way it is with regional banks, right? A lot of regional banks, they're not diversified. They don't have an investment banking sector or a custody part of their bank or asset management. A lot of these fee generating businesses that bigger banks like JP Morgan, for example, have. So they're gonna have a real problem. They're gonna have some serious margin contraction, which means that the loans that they will be willing to make are going to be to very high quality borrowers at much higher rates, and oftentimes variable. So that comes with what I think that means for the economy at a whole is that we're going to have less credit flowing through the economy.
Where are we at right now when it comes to? I mean, you articulated it well. I think the realities that costs more to have a home equity line of credit, considerably more. It costs more to have credit cards. Where are we on terms of credit card defaults, or the consumer, the exposure to debt, and are we at a tipping point? Have we started to see an increase in consumer defaults and that kind of thing when it comes to whether it's cars or just typical types of debt people would have?
No, I mean, in short,
Yeah.
the
No.
balance sheet, balance sheet for consumers has been very healthy. What we have started to see is lending standards are tightening, and they're getting tighter, as Jerome Powell said at Wednesday's press conference. Those are his exact words. And one of the notable things that we've seen is that auto loans are starting to get rejected. And that's pretty rare. So no, we haven't had any of those.
That's something we got to be watchful for. You got to assume when you have these tightening conditions.
It's one of those things that just because it's not here doesn't mean it's not on the horizon, right?
Yeah.
I guess my whole thing is here, like, continue to be vigilant. Everybody gets.
Well, also, we were in a position we've been benefiting from the stable employment, and there's jobs are plentiful, and if you want a job, there's a lot of them out there. So that's helped.
Be awesome. If wages stay at 5%, wage growth stays at 5%, and unemployment stays at 3.5% forever, right? That's I wouldn't bet on that though, right? That's
right.
That's a goal.
I think I have a little contrary view or at least something to add to that is, although there's no huge increase in defaults, we're not in that type of period. Consumer debt, just a couple of months ago, reached a record high level.
Yeah.
And so, maybe people are keeping up with their debt payments because wages are going up and employment is good. I mean, those are all legitimate things, but just Americans carrying more debt and debt being more expensive, new debt, if you will, people going out and getting cars or homes or just adding money to their credit cards, even though they can handle it now. I think it's setting up for, or at least possibility, not predicting it, not hoping for it. But if we had a slowdown and people actually started losing their jobs and they have higher debt levels, I think that's a risk. It's a risk to the consumer. It's a risk, to homeowners. And quite frankly, it's a risk to the country, which we've talked about, with varying opinions, certainly. But I don't think we're at the tipping point. I don't think Brian's wrong about the current state of affairs at all. But I don't think it's something that not us, the country and consumers, many of them are just sticking their head in the sand, acquiring more debt. The country's acquiring more debt. And someday I think there's going to be a price to pay, and it could be exposed if we did have a significant slowdown in the economy.
Brian, let me, as we kind of wind down this segment, let me get an update from you, if you would, if you're able to. Where are we in the earnings season, and how are things going as we kind of are in the midst of that time of the quarter, I guess?
Well, I think next week we're gonna hit. I think they call it peak week. We're gonna cross over 50%, I believe, of the S&P 500 companies reporting, and earnings have been very good. I mean, there's been no surprises that have been significant, and this has been the story for the last year and a half that has frustrated some folks, right? I'm happy to see it, right? We've got multiple webinars where I've posted a lot of charts with, expected earnings, and I can almost hear the scoffs through the computer sometimes. And, it's just, the reality has been that earnings have not been the avalanche of horror that I think a lot of people were almost seemingly rooting for. I don't know why.
Certainly anxiety about, right?
People that are rooting for doomsday.
Well, it went along with the people who were predicting the recession. I mean, that's the same narrative, right? They think they predicted the economy is going to be not growing or declining. So normally they'd say the earnings are going to follow, and they were wrong on both.
It's interesting, right? Like, just because when inflation is lower, right, but there's still inflation, I almost guarantee you we're going to have conversations over the next couple of months that say, Brian, how can you say inflation's gone? The price of X, Y, and Z is higher than it was 3 years ago. Yeah, it's just growing less quickly. The economy is very similar, right? It's slower than it was a couple of years ago, but it's still growing, just less quickly. So we've had a slowdown in the economy. We just haven't had a contraction in the economy, which I think is a significant difference and hard sometimes for people to wrap their heads around. So that's been, I think things are pretty good right now. They've been good for a while.
Knock on wood, may they continue.
Exactly, right? Thank our lucky stars and knock on wood and, be vigilant about the future is all you can do.
With that, let me thank you both for being with me, and join us for another time when we're going to have Jeff and Brian to talk about our last week's webinar, this week's webinar where we talked about all that's been going on in the economy and some of the reaction that it's provoked for our posturing with our client portfolios and how that might be a resource to our listeners. If you have any issues that you're thinking about with your own personal financial planning or portfolio management, and you'd like to get some help in the process, you can always reach out to us at Asset Management Resources, and you can find us at amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.